Good morning, and welcome to TOI Japan Market Radio for February 6, 2026. I'm your host coming to you from Tokyo with today's briefing for global investors tracking Japanese markets. We're here to walk through the latest moves in equities, foreign exchange, and rates, along with the key themes shaping Japan's investment landscape. Joining me is our portfolio manager who focuses on Japan macro. Let's start with the market snapshot.
Thanks for having me. So today we saw a mixed picture across Japanese equities. The Nikkei 225 closed at 54,253.68, up 0.809%, while the TOPIX posted a stronger gain at 3885.0, up 1.277%. Smaller caps and risk assets were softer, with the Mothers Index down 0.454% at 2,191.0 and REITs falling 0.758% to 2030.0. On the currency side, USD JPY moved slightly higher to 157.079, up 0.103%, so essentially flat on the session. Commodities were mixed, with gold and yen terms down 1.419% to 18,065.0 and crude oil slipping 0.284% to 63.11. Overall, it's a picture of selective strength in large caps but caution elsewhere.
That divergence between the Nikkei and the broader market is notable. Let's dive into the stories driving sentiment today. First up, we're seeing headlines about emerging market assets heading for their worst weekly performance since November. This is according to Bloomberg reporting, and it's a broad sell-off across currencies, equities, and fixed income. What should Japan-focused investors be watching here?
This is significant despite Japan being a developed market, because turbulence historically creates spillover effects here. When emerging markets come under pressure, we typically see a risk-off rotation that reduces appetite for cyclical and export-oriented Japanese equities. On the currency side, stress has traditionally driven haven flows into the yen, which would mean upward pressure on JPY and downward pressure on USD JPY. And fundamentally, Japan's export-dependent economy is sensitive to demand, particularly in semiconductors, autos, and machinery. So this isn't just a distant concern. It has real implications across asset classes here.
And in terms of specific market impacts, how are you thinking about equities versus fixed income in this environment?
For equities, we'd expect downward pressure, especially on exporters and companies with meaningful emerging market revenue exposure. Defensive sectors like utilities and consumer staples may outperform as investors rotate toward stability. On the FX side, this setup is supportive for yen strength, so we'd be watching for USD JPY to weaken if the sell-off persists. And in rates, risk-off sentiment typically boosts demand for Japanese government bonds, which would put downward pressure on JGB yields. If we see any unwinding of carry trades, that could amplify the move. The key monitoring point here is whether this weakness is transitory or signals something more systemic that could require a policy response from the Bank of Japan.
Staying with the equity theme, let's turn to today's session in more detail. We saw the Nikkei 225 actually fall 0.88% during the trading day, yet market breadth was quite positive, with 2,340 stocks advancing. And Panasonic was a standout, surging 8.41%. How do you read that divergence between the index and the underlying breadth?
That's a really interesting divergence, and it tells us this wasn't a broad-based sell-off. When you have the majority of stocks advancing but the index declines, it usually points to either heavy weighting effects or sector rotation rather than panic selling. Panasonic's 8.41% jump suggests there may have been company-specific news or investors rotating into electronics and manufacturing names. These sectors are traditionally important to Japanese equity performance, so seeing selective strength there is constructive. From a tactical perspective, this looks more like consolidation or profit-taking in large index names rather than a risk-off event.
So not necessarily a red flag for the broader market trajectory?
Correct. A modest decline of 0.88% with positive breadth underneath is not alarming. It actually indicates investors are selectively buying dips, which can provide support for further recovery. Now, if this breadth to price divergence persists for several sessions, that might warrant concern, but for a single day it's well within normal volatility. On the FX and rate side, a pullback of this magnitude typically has limited spillover unless it accelerates or signals broader macro concerns. So JGB yields likely remain range-bound, and the yen's movement today was more about external factors than domestic equity weakness.
Meanwhile, in corporate news, we're seeing some cautionary signals from the financial sector. Mitsubishi UFJ Financial Group, ticker 8306 on the ZEI, is facing margin compression challenges that appear to be undermining the bullish earnings narrative around Japanese banks. Given MUFG's importance as Japan's largest bank, what's the significance here?
This is an important story because MUFG is essentially a bellwether for Japan's financial sector and the broader economy. The issue is net interest margin pressure, which can come from several sources: a flattening yield curve, competitive pressures in lending, or higher funding costs. When margins compress, it offsets revenue gains and constrains profitability, even if loan growth is positive. For the Japanese market, this matters because MUFG's earnings trajectory directly influences investor sentiment toward the entire financial sector, which is a meaningful weight in both the Nikkei and TOPIX. It also feeds into the Bank of Japan's policy calculus, because margin pressure may reflect the reality of yield curve dynamics under their current framework.
And how should investors be thinking about this in terms of positioning across Japanese assets?
For equities, this is negative for the financial sub-index, and because MUFG is a major Nikkei constituent, any downward earnings revisions could weigh on the broader index. If we see sector rotation accelerating away from financials, that could create headwinds for the market overall. On the FX side, the signal is mixed. Margin compression might suggest the BOJ's rate hike cycle will be more limited or delayed than the market is pricing, which would be yen negative. On the other hand, weaker bank profits could mean reduced capital outflows, which might support the yen. For JGB yields, there's slight downside risk if the market reassesses the pace of BOJ tightening. Flatter curves may persist longer than expected if banks are struggling with margin expansion. So the key takeaway is this is a cautionary signal on Japan's financial recovery narrative, and it complicates the bullish case for Japanese equities tied to interest rate normalization.
Shifting back to the macro picture, it sounds like the three stories we've covered today all point to a more complex environment than the headline index moves might suggest.
Absolutely. The emerging market sell-off introduces external risk that could pressure both Japanese equities and the yen through different channels. The breadth divergence in today's session shows there's still selective strength and stock-picking opportunities, but it also signals caution among investors. And the MUFG margin story raises questions about whether the domestic interest rate normalization theme can deliver on its promise for bank earnings. Taken together, it's an environment where global investors need to be selective and stay focused on sector dynamics rather than just broad index exposure.
For our audience of global investors, what are the key themes to monitor going forward?
I'd highlight three things. First, watch whether the emerging market weakness persists and whether it starts to trigger broader financial stability concerns that might force a policy response. Second, monitor the Bank of Japan's messaging around yield curve control and any signs they're reassessing their tightening path given the margin pressures we're seeing in financials. And third, pay attention to sector rotation within Japanese equities, because the divergence between large caps and smaller names, as well as between defensives and cyclicals, is likely to continue in this environment. This is not a market where a passive index approach is likely to work well.
Excellent context as always. So to recap for our listeners, today we saw modest gains in the Nikkei 225 and stronger performance in the TOPIX, but with underlying cross-currents from emerging market stress, margin challenges in the financial sector, and mixed breadth signals. The yen remains relatively stable, but the setup suggests potential for volatility depending on how external risk sentiment evolves. As always, no recommendations here, just the data and context you need to make informed decisions. If you follow Japan's markets and want daily insights like this, consider subscribing to TOI Japan Market Radio. Thanks for listening, and we'll see you next time.
Thanks, and see you tomorrow.